Growthpoint Properties released their annual results for the 12 months ended the 30th of June 2022. The company reported that its net asset real value rose by 6.7% to 2,158 cents compared to the year before. The dividend per share increased by 8.4% to 128.4 cents, which translates to an annual payout ratio of 82.5%. The final dividend amounts to 66.9 cents a share. However, total revenue and operating profit declined slightly. To find out what's been happening behind the numbers, especially after the impact of COVID-19 lockdowns, I'm joined by Norbert Sasse. He's the CEO of Growthpoint. Thank you very much, Mr. Sasse, or Norbert, as you'd like me to call you. Just give us an overview of the operational environment and the property sectors where you saw resilience or otherwise in the time under review.
Sure. Thanks very much for the opportunity. And I think we're pretty happy with the outcome for the year. If you ask me what were the main contributors to the 5% increase in distributable income and 8% rise in dividend, 8.4% rise in dividend, standout I think has been the V&A waterfront property down in Cape Town that we own 50% of in partnership with the PIC on behalf of the Government Employees Pension Fund, where we saw more than a 50% rise in the contribution that the V&A waterfront made. So it's been a pretty impressive turnaround there. We've seen international tourism come back to South Africa in quite a big way, and we're pretty upbeat that certainly this year we would probably exceed pre-COVID levels in terms of bottom line contribution from the V&A waterfront. The other sort of positive part was the contribution from our investment into Growthpoint Properties Australia, the entity separately listed on the Australian Stock Exchange. Again, I would say since we've invested there in 2009, the best performance that company has delivered in the last 13 years. Its own profit per share, growing by 7.8% and its dividend up by 4%. Things looking pretty solid in Australia.
Yeah, that is. I was going to say, Norbert, that is a much better narrative than what we were hearing last year. But what were some of the factors that you saw where you saw your revenue and operating profit being curbed?
Yeah, look, I mean, the South African economy still continues to be, I guess, one of our biggest challenges, right? So, I mean, it's fair to say that if you look at the three sectors that we're invested in, mainly office, retail, and industrial, the retail and industrial portfolio actually performed pretty well. Valuations were stable. Rentals, bottom line, sort of like-for-like rentals were not, were probably not necessarily positive, but not materially negative. The challenging sector is the South African office sector, which still remains, our biggest challenge. Vacancy factor there is over 20%, but across the board, in the South African portfolio, we're still seeing negative reversions. And what I mean by that is, when the leases expire, in the properties, and we're signing a new lease, we are signing rentals at lower levels than what we were achieving, at the termination of the previous lease. So the South African portfolio continues to be, the biggest drag, I guess, on our bottom line performance in terms of revenues and cost. We're also seeing cost pressures, certainly administered costs in terms of rates and taxes and electricity, and the operational difficulties of dealing with load shedding. We obviously, we're not seeing any real pressures anymore from COVID. We think that most of the COVID noise is out of our numbers, and so we really are subject to the South African economy in a big way, and to the extent that we're not seeing growth. I mean, we saw the last quarter GDP number was minus 0.8%. That doesn't bode well, for rentals and renting new space and growing our rentals.
Yeah. So with a vacancy rate running at about 20% in the office sector, are you strategizing around new ways to use space?
Absolutely. I mean, every pocket of space that we own is sort of being turned over twice to see what can be done, whether it can be converted to residential, whether we could convert it into more flexible office space, as opposed to just, holding out for a big corporate to come and rent the space from us. So, we've even considered converting, some of the space to, let's call it, facilitate an education service provider or storage. So we're leaving no stone unturned to try and find alternate use, for these offices. But it's fair to say that, every vacant office building doesn't automatically lend itself to being a perfect conversion into residential or otherwise.
Yeah, so just going forward, what is the outlook? Like you've mentioned, a lot of pressures, higher interest rates, inflation, operating costs, high municipal bills. What's the outlook?
Look, our portfolio is very diversified. So we've got a pretty diversified domestic portfolio. We've also recently started our strategy of co-investment with our Growthpoint investment partners. Let's call it fund management product. We see that as a real growth area for us. We've got about 15 billion of assets under management now. We're looking to double that over the next 5 years to 30 billion. We also obviously have significant offshore exposure. About 42% of our assets are located offshore, and about almost 30% of our earnings before interest and taxes earned offshore. And we feel confident that we'll at least get some growth out of those investments, and this equity light strategy in relation to the Growthpoint Investment Partners products. So bottom line is, we got a strong balance sheet, and we think that for the next 12 months we certainly can produce positive results, albeit that it's going to be sort of nominal growth or low levels of growth, but still growth nonetheless.
Yeah, well, all the very best with that, and thanks very much for talking to us. Norbert Sasse, he's a CEO of Growthpoint.